Have you noticed in times like this, humans are becoming more and more health conscious versus the past? I mean, we make sure what we eat consists of the right nutrients, leading to an overall healthy lifestyle, and we even look after exercise as well. Now, just like you wish for a healthy body, you as an investor also wish to build a healthy portfolio, right? So, just like how different essential nutrients make up a healthy body, well, different asset classes are the building blocks of a portfolio. Now, when I mean asset classes, I'm talking about equities such as stocks. It can be compared to, say, lean protein, offering growth potential and the ability to build muscle. Then there is debt in the form of bonds. They can be thought of complex carbohydrates, providing stability. And the final asset class is gold, the precious metal. It's like healthy fats, offering diversification and help against market volatility. But just like how the excess of any of these nutrients, be it fats or proteins or carbs, can lead to potential harm in the body, over-investing too in any single asset class can create an imbalance in a portfolio. Therefore, we say diversification across asset classes, also known as asset allocation, is a must for all investors. So, there can be two ways you build a diversified portfolio. I mean, the one way is the DIY way, the do-it-yourself way, where an investor himself decides the asset allocation. While the other way is through a ready-made diversification solution by way of investing in multi-asset fund of funds, which invests investors' money across asset classes of equity, debt, and gold, thus reducing dependence on a single asset class. Well, first, let me explain the do-it-yourself way. For this, the quantum mutual fund asset allocation mantra of 12, 20, 80, also referred as 12, 20, 80, comes to the investor's rescue. Now, you might ask how the 12, 20, 80 can be an asset allocation framework, as they don't add up to 100, right? Okay, let me break it down for you. The 12 part stands for 12 months of monthly expenses. This component requires that an investor should at least invest 12 months equivalent of expenses in a safe asset class, like debt. Investors should have this amount in a very liquid and safe investment. The intention is to build an emergency corpus and not really returns. When you want to withdraw this money, it should be easily available. So this is your emergency corpus. Remember pandemic, right? It was an emergency. Having something like this really helps. Now, once the requirements of an emergency fund is met, then the next component requires you to invest 20% of your overall portfolio into gold. Now, generally, it's been observed that gold and equity prices have an inverse relationship. So when one increases, the other decreases and vice versa. Now, this will help in providing stability or a cushion to your portfolio against market volatility. The remaining 80% of your portfolio can be invested in equity. Now, this component will help your portfolio chase the returns and help in the long-term wealth creation story. So this is how the 12, 20, 80, 12, 20, 80 component is broken down to help investors build an all-weather portfolio. Simple, right? Now, once the essential nutrients are identified, what's your next step? Of course, you identify the food source that can help you gain required nutrients. Similarly, when the asset classes are identified, your next step is to decide where to invest to gain exposure to that asset class. Well, Quantum Mutual Funds offers the right kind of funds to help you gain exposure to different asset classes. So, to build that emergency portfolio, you can invest in the Quantum Liquid Fund. And here are the benefits. First, it follows the principle of safety and liquidity over returns, so it doesn't take that high relative risk. It invests in top quality, top rated papers and has relatively low interest rate risk and relatively low credit risk. For the gold component of your portfolio, you can invest your surplus in Quantum Gold Fund ETF or invest in the Quantum Gold Savings Fund. An investor can gain from the following benefits. One, it's backed by 24-karat physical gold. There is an independent purity test for all gold bars held. It's a safe investment. There are no making charges and there's easy liquidation. Now comes the most interesting part. Where do you invest for the equity component part? Because equity will comprise a majority of the portfolio and be the growth part of your portfolio as well. But before that, you must understand two ways to build the portfolio. So one way is an active way, while the other is passive. So an actively managed investment fund is a fund in which a manager makes decisions about how to invest the fund's money, while a passively managed fund simply follows the market index, like Nifty 50 or Nifty Midcap, etc. It doesn't have a manager making investment decisions. In terms of cost to the investor, we also call that the expense ratio, it's generally higher for an active fund compared to passive funds. Quantum mutual funds offer you both ways to build a portfolio. While the debt and gold component discussed above remain the same in both ways, only the equity component actually differs. So under the active approach, 80% of the equity component amount is invested in Quantum Long-Term Equity Value Fund, Quantum India ESG Equity Fund, and Quantum Equity Fund of Funds. While under the passive approach, which is the second approach, the amount is invested in a Quantum Nifty 50 ETF Fund of Funds and the Quantum ESG Fund as well. Investing in equities via Quantum Mutual Fund will have the following benefits: achieving long-term goals with some peace of mind, a one-stop shop to learn, plan and invest like a pro, decoding the markets with assortment of tools and resources, and adjusted risk returns for a brighter future with various investment options. Now, all this might seem a little complicated and you don't really have to worry about it. Quantum Mutual Fund comes with an asset allocation calculator that will automatically help you with the amount and where to invest, so it's easier for you. For this, you simply have to visit Quantum's website, scroll down and you will see a calculator window. Choose whether you want to make an active or passive investment. Enter the total planned investment amount. It's the total amount you plan to invest across all the three asset classes. Then enter your monthly expenses. Please be honest over here, otherwise the calculations will be wrong. This will help the calculator calculate your emergency fund that has to be invested in the liquid funds. Below this right here, you can see 12, 20, 80 titled rows. This is exactly the asset allocation we just taught you. Please note that there are default settings and you can change the allocation percentage as per your choice. So let's say you're in your 40s and you want to be more sure about future emergencies. So maybe instead of 12 months, you might want to make this 24 months. If you are in your 20s, you maybe opt for a 6-month emergency fund, and perhaps that's a good step to begin with. So this is the calculator, totally flexible and customizable. It's just going to make your life a little easier. Once you click on calculate, it'll automatically do an allocation for you and show you the list of funds you can invest in as per the input fields you provided. Now you can change your preferred allocation too as per your preference, and you can check for other details like expense ratio and historical returns. So this was all about the 12, 20, 80 allocation framework and how this calculator comes in handy. And this was the do-it-yourself way of building your own portfolio using the allocation framework. However, if you want to avoid hassle of investing in multiple funds and doing your own calculation, Quantum Mutual Funds offers an alternative way for your portfolio. It's called the Quantum MultiAsset Funds of Funds. Let me explain. As discussed earlier, MultiAsset Fund of Funds is a ready-made diversification solution which invests investors' money across asset classes of equity, debt, and gold, reducing your dependence on a single asset class. So you as an investor will get the benefits of dynamic and research-backed asset allocation, the aim to generate long-term risk-adjusted returns, diversification across equity, debt, and gold in quantum mutual funds, periodic rebalancing, and tax-efficient rebalancing. So here's a quick summary to make this a little easier. 1. Diversification is a must for all investors across different asset classes. The 12-20-80 asset allocation framework can be used by any investor to practice diversification. Either an investor can use Quantum Calculator to build his own do-it-yourself portfolio, or investors can invest in the Quantum Multi-Asset Fund of Funds to get exposure to multiple assets by investing in just a single fund. So the choice is yours.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.